What is going on, traders? In this video, we are going to be talking about internal and external liquidity, basically about liquidity in general, but also when people refer to external liquidity, what exactly are they talking about? And when people refer to internal liquidity, what exactly does that mean? We are going to cover both. We're also going to delve a little bit deeper into the terms of liquidity. I'm sure you will find a lot of this value in this video, so make sure to stick around till the end. So to start off, here we can see some examples. First, we have a bearish trend right here. In the middle, we have a bullish trend. And on the right, we have a ranging market. So when it comes to liquidity, and that is mainly for SMC and ICT concepts, we will know that liquidity is residing above this high and above this low. There's liquidity residing above each high and each low, especially above each and every structural high and low. And this is what we define the internal liquidity. Now, all of these examples, for example, are going to be based on our higher time frame, which we use to actually establish our narrative, which we do our main analysis on. And then when it comes to refinements, we will drop into that later. So what we can see is that above this high is liquidity, near this low there is liquidity. This liquidity gets taken out, we move lower. Then of course above this high there is residing liquidity. We then move lower again, create a new high, liquidity build up above this high, and then we proceed to actually take out the liquidity below this low right here. There we go. So as you can see right here, we have three pools of potential liquidity where the market might in the future actually return to. And right here, we have quite efficient marketing because we're taking out all of these sell side liquidity here. Now, in this particular example, we have liquidity build up near this high, which gets taken out. We have liquidity build up near this low, which remains intact. Liquidity build up at this high, which also gets taken out after we induce liquidity with that low, and so on and so forth. And then on this example on the right here, as you can see, we are basically inducing relative equal highs. So it's very easy for us to spot the liquidity here. The liquidity is going to be the relative equal highs. So here we will have trend line liquidity. We have it both on the buy side as well as on the sell side right here. So we know that if price takes this out, it will likely go for the other side as well, or do something in a similar fashion. If it doesn't go for it right away, we can know almost for certain that in 99% of the cases, price will go back for that specific point, possibly not on the day itself, but possibly the day after or later in time. Now, if we think about all of these structural points as being on the higher time frame, so let's say, for example, this is all 15-minute price action, then we can call all of these points our external liquidity, because this is the points, these are the points that we think are going to be liquidated. But of course, we want to see what the market's hand is going to be showing us, right? Is the market going to gravitate towards that high? Do we get a signature for that on the lower time frames? Is the market going to continue bearish and take out this low, which in this case it did? We all need to study this on both the higher time frame as well as the lower time frame. I'm not going to delve too deep on draws on liquidity and how to identify them. I'm sure you'll find a lot of value on my YouTube channel about that already. And if you're interested in more in-depth and guided mentorship together with a course, I do have that available, and I will leave a link in the description. These spots are limited. We are almost full. And at that point, we will basically close and we will be working application based and we will be very picky. So if you're interested in something like that, now is your chance to look into that. So continuing to our internal liquidity. As you can see right here on these markups, we still have our external points of liquidity marked up, but we just went to a lower time frame. Let's actually put a story behind the price action that we are currently seeing right here. So right here, as we can see, we induced liquidity. This is internal liquidity because this is not a major structural point on the higher time frame. So right here, what we can see is that we swept internal liquidity. Right after sweeping that internal liquidity, we started to really run down quite aggressively, creating this new structural low right here that we can also see on the top image right here. The market then starts to run up. And as we can see, we take out this liquidity that was built up right here, which is an internal point of liquidity. It's an internal high that we create. The market then runs lower, takes out the previous low that we created, fueling that move back up towards our buy side right here. We then notice that right here, we do not really sweep liquidity. We aggressively break structure. So this is the market basically showing us its hand that it wants to proceed higher towards next liquidity. We could play this, for example, in ICT terms around equilibrium. For example, here we have a breaker block. We could have potentially caught an entry there targeting the next point of liquidity, which right here is going to be this high, for example, which we do tap into. What we then see is that right here we induce even more liquidity, and this is all internal liquidity. As you can see, we basically create relative equal highs right here, and that is what we could have targeted. Now, right here, what do we see? We liquidate this pool of liquidity, right, with this specific high that we create, which is also the external liquidity that gets swept. That gets induced right here. Then right here, we have a straight run lower. So really aggressive movement, probably because we swept liquidity here. This is something that you will see on the charts yourself. We will give you some examples in just a minute, but I do recommend you to study this yourself as well after the video. Then right here, as you can see, we kind of range around. We create this low. So there is internal liquidity induced right here. So right here and right here, we then take out the induced liquidity from the buy side. The internal into induced liquidity gets taken out. We then also take out the induced sell side liquidity, also internal sell side liquidity, before we actually start shooting upwards, as you can see right here. And then after that, based on the higher time frame narrative that we had, we can assume that price did something like this. I hope that makes sense. So this was the bearish example. As you can see, while we do indeed have these external points of liquidity, that doesn't mean that we cannot look at the internal structure and the internal liquidity, because as you might see on the 1 minute, we also have quite a bit of sweeps, which do not specifically correlate to the external liquidity, but we do see a buildup of internal liquidity for the market to be able to make those moves. Because for every move to the upside, we need to sweep liquidity on the downside and vice versa. Another example right here for the bullish price action. So as you can see, when you look at this specific price action, I do think it will feel kind of familiar. This is something that you've probably seen in live markets before. This is something that's picture perfect, and this is how it will likely look on the charts. So to give you a story right here, again, we induce relative equal highs as internal liquidity, right? This time on the buy side, we take that out right here and price drops lower. We induce a high right here, then create our structural low for the external liquidity that we spotted right here on the higher time frame. That's where we create that low. Then as you can see, the market takes out the buy side liquidity right here that we induced, which was also internal. We create a new low. We actually break structure right here. And then we notice that we actually come back for that low that we induced. We take that out, and that basically fuels our move to the upside. And why is that? Well, there are a lot of stop losses below this low right here. That is why the market moves to that and then starts shooting upwards. Next up, we can see we create a low, create a high, move lower. We then sweep that high that we create, that induced high, before inducing a low once again. We then start moving higher. And as you can see, once we take out that high, we start faking people out. And this could be the support and resistance traders. This could be supply and demand traders. We fake those out with a fake move to the downside, which is basically induced liquidity. We move to the upside, create that structural high right there. The external liquidity gets built above that. We take out the liquidity right here, the internal liquidity from the inducement from this low that make the fake move. And then what we can see right here is that we actually take out this low again, have a fake move to the upside, possibly inducing liquidity, and then we have that run lower. Now, if we think about it, what could this possibly do? If we look at the market, we did sweep liquidity right here, but we know that we are bullish, right? We overall have bullish structure. So can we assume that happens? We can assume that this liquidity is going to be targeted next. Once we take out that liquidity, we might have enough fuel to make a move to the upside that will look something like this, and then have our continuation. So as you can see, if you go to the charts, you will notice that whether it's external or internal liquidity, because the external liquidity on your 15-minute time frame might actually be internal liquidity for the 4-hour time frame, right? So it's obviously of fractal nature. Try to look at the charts with a critical eye like that, and you will start seeing really clearly what the market is actually intending. All right, so right here for the ranging market, you would think, hey, the market is not really doing anything, but what it is actually doing is it is inducing buyers and sellers into the market to liquidate whichever side is the biggest. So if we take a look at the charts again, what do? We induce internal liquidity. We have a high. We take out that high before we have a move lower. Once we take out the sell side liquidity right here, we have a reaction to that, to the upside, which is just inducement, because as we can see right here, we take that out. We have a move lower, faking people out. Now right here we're low in the range, so people are probably going to be thinking about taking longs. All we do right here is take out that internal liquidity for us to make a move lower and take out the induced internal sell side liquidity. Take that out, have a move up, in this case inducing more liquidity. So the more times that the market respects this high, that's where the resistance traders are going to be jumping into shorts, right? Every time that happens, we are going to build up more liquidity for the market. Then right here, we move straight for that low. We liquidate that. We then have a move to the upside. We tap into the support right here that we could have on the bottom, trapping those people into longs. What do? We liquidate people that were short and at their stop right here. We then induce more liquidity. As you can see, we then take out the liquidity right here from that induced high before moving lower, sweeping even more liquidity right here. And what do we often see happening then? That is that this will often take out these relative equal highs for us to make a continuation move like this. Boom, boom. Faking people out to the upside. So we have the, what do retail call it? The break and retest, right? So we break structure. We have a retest of our zone. We notice that we again break that high. So a lot of people will step into longs right there. We will do something like this, induce even more liquidity, take out the liquidity for us to then run towards those lows right here. This is what we will see happen quite often. Now, of course, this is all price action that you can actually benefit from. So as you can see, a lot of people are basically getting screwed over right here, right? A lot of people are getting tapped out of their positions. People are getting stopped out. And you can actually benefit from that. If you start looking at the market with an eye of liquidity, you will start to actually become the smarter money. You will be able to avoid getting stopped out and basically enter where other people are getting stopped out. And that is the ultimate goal, because that is how you differentiate yourself from the 99%. Now, if you want to learn how to exactly do this, I do encourage you to actually check out my elite program. You can go check out the website. You can also jump into the free Discord server where there is a ton of value provided already. And right there, you will also find a testimonials channel and you will see what the elite members basically think about the program. Again, we are going to close the program real soon. So if you are still interested in something like that, make sure to jump on board right now, because it could be that tomorrow the elite program is no longer publicly available. All right, guys, I really do hope that you found value in this video. I know this has been a lot pushed together in one video, so I do encourage you to possibly rewatch this video as many times as you actually need. And I hope to see you in the free Discord server. I hope to see you there. Hope to have a chat. Cool, guys. Catch you in the next one.